Welcome to the Goose Hollow Capital Weekly Market Update. In this edition, we'll recap recent events, preview what's on the horizon, and share some interesting charts and market price action that caught our attention. We start with a chart of inflation in emerging markets. As we can see above, disinflationary trends continue to take hold in emerging markets. Through proactive tightening in 2021-22 and subsequently holding rates steady, EM countries now see prices move back into range, approaching target. And high real rates will eventually bring inflation back to target for countries with stickier inflation as tight conditions and growth slowdown weigh on prices. This makes EM linkers and bonds attractive as the Fed embarks on an easing cycle. Next, a chart shows the average monthly returns of the S&P 500 since 1990. April and November have the highest average returns, each exceeding 2%. September has the lowest average return, around -1%. Most other months have positive returns, with modest gains in January, February, July, and October. August is also slightly negative. This highlights a seasonal trend in the stock market, where certain months tend to perform better or worse historically. Next, a quick review of how S&P 500 performs 3 months around the elections. We see that there have been muted equity returns 3 months into the elections and historically perform well 3 months after the elections. Will history repeat itself this year? Next, we look at flows into Mexico. The chart on the left shows retail outflows from Mexico-focused funds. The chart on the right shows Mexico's growth indicators by month, broken down into contributions from labor, manufacturing, consumer, and other sectors. Manufacturing, teal, and consumer sectors, orange, are the primary drivers of growth. We can see that there is early signs of a manufacturing rebound in Mexico. The judicial reforms announced by the new president has been an overhang on Mexican assets, but early signs the market has overreacted to these concerns. Next, we look at the chart of the 2s-10s yield curve, which has been inverted for over 567 days. Historically, the curve uninverted as we got closer to a recession. As the Fed starts cutting rates aggressively, markets have priced about 115 bps of cuts before end of the year. We expect the curve to normalize and to bull steepen from here. Next, according to Penn Wharton's budget model, the policies laid out in the Trump campaign's tax and spending proposals would widen the primary budget deficit, which excludes costs associated with interest outlays, by nearly 5x more than those in Harris's plan on a conventional basis. Trump's policies would clearly catalyze a more serious break from the primary deficit's historical average of -1.6% of GDP. This will increase the term premium and potentially a bigger steepening in the yield curve. Next, we look at a chart of the recent collapse in the price of solar modules, and on the right is a basket of global solar stocks. China's solar panel industry is experiencing a significant price collapse, with module prices plummeting by approximately 40% over the past year. This dramatic decrease is primarily driven by China's massive production capacity, which accounts for about 80% of global solar module manufacturing. The oversupply has led to module prices in China dropping to just 10 cents per watt. While this price reduction makes solar power more accessible globally, it's creating intense competition within China's solar sector and causing concerns for manufacturers worldwide, chart on the right. The situation is particularly challenging for non-Chinese companies trying to compete on price, as China's dominance in the market continues to strengthen. What are the consequences of cheap solar and battery storage for energy prices and global markets? The final chart above shows the longer-term average price of monocrystalline silicon solar modules, which has seen a significant decline from about $1.50 per watt in 2011 to less than 10 cents per watt in 2024. This reflects the general trend of decreasing solar module costs due to advancements in manufacturing, technology improvements, and economies of scale. After the steep declines, there are periods where prices stabilize, particularly from around 2017 onward. The prices for made in India and shipped to US modules diverge slightly from the overall average in recent years. Meanwhile, the shipped to US average is generally higher, likely due to shipping, tariffs, or other factors. That is it from us this week. Thanks for watching. This material is intended for information purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities to any person in any jurisdiction. The opinions expressed are subject to change without notice. This information is not intended to be complete or exhaustive, and no representations or warranties, either express or implied, are made regarding the accuracy or completeness of the information contained herein. This material may contain estimates and forward-looking statements, which may include forecasts and do not represent a guarantee of future performance.